Hi, everyone. Welcome to another Idiot's Guide to Investing. I've got Paresh with me. As I keep feeling the need to say every week, it's not because I think we're idiots, but it's just to look at the idiotic things which we might have noticed in the past week. I guess for me, one of the things with these falling markets, Paresh, is people not looking at their portfolio. I don't expect them to look every day, but at least once a week. I had one or two people who've come back and said, "Oh, I didn't look at it for the last 6 months." So even if you've given all your money to a fund manager, you should be looking at it more than once every 6 months. What do you think? What's your take on that?
Well, yeah, I completely agree. If particularly with sizable funds, you've got to take some responsibility. It is your money after all, yeah. And it would seem nonsensical, in all honesty, not to be aware of what somebody else is doing with your money if you have given it to a fund manager. Yeah,
yeah. It's sorry, go on.
Yeah. So, but I can understand. There's going to be a feeling that if the markets are dropping as they have been, you don't want to look at the pain.
Yeah, you want to put your head. You want to do the ostrich thing. You don't want to open the letters. I used to write about this in the FT. You don't want to open the letters from when you used to get letters from brokers. Now it's PDFs behind 6 layers of email security. So there's no issue about looking at it because you can't even bloody access the statement from the broker. But yeah, you don't want to look at it because you're afraid.
Yeah, exactly.
So what to do about that? Got to force yourself, I guess.
Well, you have to force it. Well, you see, there's a couple of things here. You can, of course, force yourself, but then not to have a plan or I guess, a suggested plan of action should something go be worse than you expect it to be, for instance. Yeah.
Yeah.
And not to stick to your trade plan in the first place is the reason you're in this position also. So.
Yeah, exactly. I mean, I did that flow chart you would have seen this week, and I put it on my Telegram for that reason. It's just to keep on referencing. And then what I realized is that after doing that flow chart, people will still not necessarily follow it. So I did a video so that they'd look at it. And then I emailed it out because they won't look at the flow chart. And then I did another video on the first video talking about, okay, these are the really difficult decisions you don't want to take. So to make sure there was sort of a double impact, but you're absolutely right. People don't want to do it. But if you look at wealth, it's like health. You're not going to get a call from the NHS usually saying, "Hey, you know what? We're just wondering how you're getting along. Have you checked, all your bodily bits to see if there's lumps in areas that there shouldn't be lumps and all the rest of it?" Sometimes you get a letter, you get an email, you'll see it on the media, but in a way, there's a lot of people telling you to do it. So that was one. Leverage. I mean, we're using the word idiot sort of pejoratively, but we don't actually mean it that strongly. What we mean is just the mistakes we all make when we were learning. We all did it. Let's turn to leverage. What are you seeing this week?
Well, actually, let me share a story, which I kind of shared with a few people now. But the very first day I started trading back in 1992.
Mumble that. 1992.
Yeah.
1892.
Yes. I didn't fully understand what leverage was either. And within...
Well, wait a minute. You're a professional floor trader on the floor of London's largest futures market.
That's right. And I didn't fully appreciate...
See, this, you know what? When this goes on social media, this just underlines what everybody always suspected about finance. Exactly. And nobody in finance has a freaking clue what they're doing, other than probably some PhD, and he's got the maths wrong.
Yeah. Yeah, he's curve fitting mostly, that PhD client. Anyway, so, but yeah, I didn't fully appreciate the impact of leverage fully on my first day of trading. And I think it was within 3 minutes, I was down 10 grand. Yeah. And for the next 2 weeks, I was biting my nails, wondering if my boss, David Kite, was going to be sacking me or not. He actually left to Israel for a couple of weeks. So I didn't know until he got back where I'd be when he did get back. So there's
a lot of places to pray in Israel. You should have gone with him. out to the western wall and just started praying, mate.
Bang my head. No, sorry. But it's so it's nothing to be ashamed of if you don't fully understand it. But if you have got yourself in deep water, there are ways and means to get yourself out strategically and not bury your head in the sand so much. So this is the thing about leverage. Yeah. And because of that one first day, it's all about risk management since then for trading, generally for me. It's how much am I happy to lose that day, and my temperament's got to be the same, whether I've lost it or made money that day. So, yeah.
Yeah. And on that, I mean, the leverage point is, and again, going to this understanding bit, I find a lot of private investors they sort of skate over the risks. They look at the upside and they're like, oh my God, this is amazing. I can make 100% in a week, a month, a year, whatever, 2 years, whatever. But they don't look at the drawdowns and then look at the leverage of the drawdown. And you can point it out to them. And we used to do this, you and I, I'm sure, which is in the early days, you'd be like, no, I've just got to make it. And what I'll do is the risk I'm going to take is that the markets will go in my direction, hopefully. Well, guess what? It's like the casino. It's sod's law. Basically, you bet on red, you know it's going to come up black. And that's what they're hoping for. Look at the drawdown. If professionals didn't look at the drawdown, if the professionals didn't look at how much can it fall from peak to trough, and what if today when I buy it, it does its worst ever drop for however long it might take, 3 months or whatever. If professionals were able to ignore that, they'd have all the money in the world. That's why they, trade small amounts, because they know that sod's law is going to happen. It's going to hit them as well. And that's what we're really about. We're just trying to dodge bullets.
Yeah. Well, not only that, people don't fully appreciate why professionals use leverage. They don't use leverage to increase their risk per se. They use leverage to increase the number of positions they have with the same risk.
Yeah, and that's a very subtle, good point, actually. Leverage doesn't increase your risk reward because, yes, you get double reward, you get double risk. So your risk reward stays the same. But you're right. The reason you might use leverage is because if you only had, say, for argument's sake, £10,000, you could only buy a certain amount of Microsoft.
That's right.
But if you use leverage, you're effectively buying more Microsoft. But as long as you appreciate that you don't want so much leverage that should Microsoft drop 50%, you're wiped out. Now, chances are it's not going to drop 50%, so you won't be wiped out. But you want to make the assumption it could. And the mistake most people make is they make the assumption it won't even drop 25%, because they'll say, well, it hasn't done in the last 5 years. Well, sod's law is. Or they might say, you know what, it's fine. Now, this bit's fine. So I've got Microsoft. I've got it leveraged. It drops 25%. I say to myself, what was my strategy all along? Well, it was to hold longer. So, okay, I wish it hadn't. I wish it only went up, but it's fine. I'll just keep with it because I intend it for longer. Others will say, I don't want this pain. And that's the other bit you don't know. You don't know what's going to keep you up at night. It's like going on a roller coaster. Oh, it looks great. All my friends went on. Let me go on. And you're hurling after the first dip, and it's like, I want to be like them though. Well, you're not like them, so don't do it. Anything else that's come across your desk this week you want to talk about? Sort of any good and bad stuff?
Well, that was the main thing was about leverage and people's anxiety to get out of losing positions. That were the two main things that
Yeah, and if you're anxious, I mean, that tells you what your risk profile is. It's like being at a dining table. If you feel full and your stomach's hurting and you've got to undo your top button, it's pretty much telling you that your appetite is full. Similarly, if you're anxious, then you've taken on too much risk. And of course, that takes time. You might spend your first year of investing learning that about yourself. And as long as you don't make the same mistake the second year and so on, you realize, you know what? I'm not a size 36 around the waist. I'm a size 38. Maybe I ease back on my risk appetite, my food appetite a bit. I'm not who I thought I was. And that's perfectly fine. It's when they're trying to be somebody else. And the sort of the warning signals for me are when people ask me, what are you doing? Can I copy what you're doing? And it's like, no, because you're not me. Yeah. I might be able to take on a hell of a lot more stress than you. How do I know? And that's part of your risk appetite.
Well, interesting. 2 points there, going back to the early story about being on the floor. So David Kite didn't tell me how to trade. He showed me how to trade. So he would ring me up and he would be trading 10 lots at a time. Well, I'm trading 1 lot at a time, for instance. Yeah. So he's doing 10 times more risk than I am, ultimately. And that was his minimum. He would do a lot more typically. What's more interesting is it took me 6 to 7 months to make up the 10 grand that I'd lost. And then it was, so the evolution of a trader and your temperament and everything improves as you start winning more. So you need to have those, those consistent wins. And then you can be a little bit, you can push the boat out a bit more and take a bit more risk and understand what that means. So it's a lot more controlled, and it is a full-time job, ultimately being a trader for sure.
That's if you're trading. I mean, we go back to the investing part, and luckily investing isn't full-time because as long as you just keep an eye on it once a week at least, and that if the market drops 25% or whatever, you're going to get out. But what worries me is when people know what the plan is, and it's like anything in life, they take all the trouble to get the plan. Maybe they even got a mentor to advise them to get the plan, and then they don't follow it. I mean, look, don't get me wrong. I pay for gym memberships and then I don't go. So, when it comes to personal fitness, I know what it means to make the same mistake because it's human nature. We do it in everything in life. But all I can keep saying to people and banging them over the head over is don't, make the plan and then not execute it. I think that's been 10 minutes, I'm afraid. We're going to keep these short and sharp because, well, we've both got attention deficit disorder, but because these are going to be the number one podcasts in finance anywhere in the world, I think 10-minute snippets would be great.
Yeah, agreed.
All right. I'll speak to you next week. Thank you very much, my friend.